All right, good Thursday afternoon, Finom Group members and our general YouTube audience. My name is Seth Colden. Welcome to another State of the Market. And we've got a bit of a rally going on, right? Continuation, follow through. Haven't been able to say that a whole lot this year. For the most part, investors have had to suffer through what you see on the screen here. We start at point A and we're trying to get to point B. We'd much rather have a smoother plane to travel through, right? That's not the way investing goes, though. That's just not how it works. You're going to have your pitfalls. You're going to have some challenges along the way. Some folks are going to sink. Others are going to survive. But it's a treacherous journey. And that's what 2022 has been about. This is the ideal situation. This usually is your reality. We plan for this more often than not, but this is what the market delivers. It's normal. It's to be expected. These setbacks, these corrections. I definitely would not say 3 bear markets in 4 years is to be expected. But you take what the market throws at you if you're gonna win in this game, and you gotta be patient. Here's something from Charlie Munger. Waiting helps you as an investor, and a lot of people just can't stand to wait. If you didn't get the deferred gratification gene, you've got to work very hard to overcome that, right? Instant gratification. I bought a stock. Why isn't it going up today? Why hasn't it gone up this week? Why hasn't it gone up this month? That kind of instant gratification. There's a lot of, especially the newer investors, that they got to get over that. Sometimes it takes many months. Sometimes it can take a year or more. When you go into a bear market, you've got to extend those time horizons. You might have planned for this, but this is what happens when you have a bear market. You got to take, because you got to travel this route, then back up. We're basing, you could say. This is a basing pattern until you get to the finish line where those profits are realized. So good stuff from Charlie Munger. I know we had the Fed meeting yesterday, and I'd probably be regret not saying or offering some of my thoughts on the Fed meeting. Extremely hawkish. I know that everybody's heard, the market is taking it as dovish, or you got these folks on CNBC, they sounded less hawkish. No. Heavens no, folks. Think about where we were in 2018. Could you imagine, for those of you who listened to yesterday's chairman, in the press conference after the rate announcement, if you listen to the Q&A session with Jerome Powell, you heard him say, and again, imagine if this happened in 2018 when the market threw a pretty good hissy fit, that they may have to take policy into restrictive territory, and that all options are still on the table. We might see extremely large rate hikes in the future. What about that was dovish? What really happened yesterday is that you had the market pointed in one direction, right? Investors were pointed in one direction. And that's just, the market getting in and of itself, having follow through, and just pushing ahead. But in terms of the Fed sounding less hawkish, even dovish, sorry, but the words that I just reiterated from Jerome Powell have nothing to do with dovishness. And so what we see on, CNBC or Bloomberg, when they try to preach that, we thought they were, no, you're just following the price action. The price action was bullish. We tend to think that they must have said something less hawkish or even dovish. Reality was that was the most hawkish I've ever seen. The words, and it's not like he said restrictive territory once. It was at least a handful of times. Extraordinarily large rate hikes. He said that 3 or 4 times. In no way, shape, or form was that dovish. Again, why did the market still rally? Maybe the market is thinking, well, better to get us into a recession sooner than later. Who knows? Right? Because the markets do tend to bottom at least 4 months or 4 months on average before the recession is over. So just because we may go into a recession doesn't mean the market hasn't already priced that. My opinion, extremely hawkish, but maybe that was necessary. And maybe the market believes that the Fed is going to tackle this one way or the other. And that's what the market wants. Maybe. There's no sure answers here. We'll only know in hindsight. Having said that, and with the NASDAQ was up 4%. This is best day, I think, since April of 2020. NASDAQ was up 4%, right? The worst performing index was the best performing yesterday. And that might be something you need to get used to as well, folks. Right? What hasn't been working or working the least may start working more and the best. So here's something that I also wanted to consider. I think investors should consider this, right? Side note on the Fed. I can't see FOMC members appreciating the market's reaction to their message outlook in July rate hike. They desire diminishing wealth effect, not an advancing one as they battle inflation. Consider Fed officials may start to push back on positive market reaction, therefore potentially stifling the advance that began in late June to present. Right? The Fed doesn't, the wealthier we feel, we're going to go out there and spend more. And that's not going to help them on the inflation front. So it wouldn't surprise me when Fed speakers and their speaking engagements kick off again in next week and through the upcoming month of August. Don't be surprised if they reiterate some of the hawkish statements from Jerome Powell. Try to tamper things down. I'm not saying they'll be successful in doing so. Just don't be surprised. All right, we are heading into August. August, going back to 1981, kind of sucks. It's literally the worst month for the S&P 500 going back to 1981. Doesn't mean history is going to repeat, but it is something to keep in mind. July's pretty darn good. September's bad also. So seasonally wise, yeah, and again, you don't want to use seasonality in a vacuum. In terms of capital allocations and expectations, I always choose to pair seasonal data with some type of other quantitative data. Big day for the S&P 500 on Fed Day. Again, in fact, 3 times this year that the Fed has raised rates at an FOMC meeting. In the last 3 times, the market has been up 1.5% or better. One of the occasions that the S&P was up 3+%. So yesterday's 3% rally in the S&P, 4% rally in the NASDAQ, not a big surprise, kind of on trend, but the day after that is bad. Anytime the S&P 500 has had a greater than 2% gain on FOMC day going back to 2008, the next day's average move down 1.2%. Only 3 winners and 8 losers. So it has happened 11 times in the past. The market was up greater than 2% on a Fed day. 11 times, only 3 times was the next day positive. How are we doing today? Is the average performance working here today with, well, it's 2 o'clock now. We got 2 hours to go. Answer looks like no. In fact, we're at the highs of the session. I like that. Why? It's bucking the trend. We're above the 20-day moving average. We're above the 50-day moving average in the key indices. We're getting follow-through week. There's a lot of bullish stuff going on here, folks. We've talked in the past about good things happening below the surface of the indices. Now we're looking at the indices actually producing those good things themselves. It augurs well. It augurs well. I'm going to be on the augur tick probably the whole of this state of the market as a warning. I think that's my word of the week, augur. Anyways, okay, corporate insiders. I keep following this week after week because they tend to be right. Historically, they just tend to be right. I mean, their batting average is extremely strong. So corporate insider buys keeps moving higher. Like they're buying this bear market, folks, in droves. Selling is at lower than where we were in 2019. And here we were in 2020. So they're not selling. All they're doing is buying. It's pretty awesome. Here's another. This is the buy-sell ratio, or sellers to buyers ratio, I should say. Sellers to buyers, insiders. The ratio of sellers to buyers is back down to 2020 levels. Or I guess that's right here. So insiders, they're not sellers. Regardless of what they're reporting so far as earnings and guidance, they're buying their stock. Things feel so bad, right? Things feel so bad in the economy. We've been hearing that all year long. We're in a recession. We're going into a recession. It's going to be a deep recession. Look at the housing market. Inflation sucks. But the reality is we're not in a recession. I say that on a day where we just got the first look at the Q2 GDP, and it was -9, -0.9%. And that's on the heels of the first quarter, a negative GDP of 1.6%. But again, the National Bureau of Economic Research is tasked with labeling a recession. I have no confidence that they're going to label the first half of 2022 a recession. The coincident economic index has been up every single month of this year. Every single month. And we only have, well, we'll get to that in a little bit, but it feels bad. Look at the misery index, high inflation. We've got low unemployment, but man, I mean, misery index is at the highest level since the pandemic. Is this a No, it's not a pandemic. You have to go back to the European debt crisis, to show a misery index at this kind of level. It feels bad out there. Just feels bad. I think that's a byproduct of inflation and the fact that we're in a bear market. I think that has a lot to do with it as well. The average household, they get their 401k statement and they see declining value in their 401k, and then they go to the grocery store and their ticket is higher than it's ever been. Those two things just don't work well, for the average consumer. So I get it. Misery index, moving higher, significantly higher. It feels bad out there, and this bear market feels bad. We look at the 2020 bear market, which was deeper at 34% drawdown. And if I ask, 100 different investors, does this feel worse at a 24% drawdown in 2022? Just a 24% drawdown or bear market from peak to trough this year versus 2020's 34% drawdown. I would think 9 out of 10 of the people that I ask is going to say this feels worse. Why? Duration. This one is, we're 7 months into it. We were barely from peak to trough. And, this chart shows you, this is the current bear market. The pink line is the current bear market. I remember pink. But this 2020, look at that. I mean, V shape, boom, and over and done with looks like 150 days. From here to here, 150 days is all it took. We're 7 months into this bear market. It's just lasted longer, so it feels worse. But maybe it's over. Maybe it's over. One of the things that we wanted to see is, bad news be good news through the earnings season, right? The number of companies that have missed earnings, but their share price has gone up, has been incredible. Companies that have reported negative earnings surprises for Q2 2022 have seen an average price increase of 2% 2 days before the earnings release through the following 2 days after the earnings release. How does that compare with history? This percentage increase is well above the five-year average price decrease of 2.4% negative during the same period, 2 days before and 2 days after the earnings release. Usually it's a drop of negative 2.4%. We have a rise of 2%. Bad news is being rewarded. That's one of the signals of a market bottom or bottoming process. Basing. Here you can see, how does that, just kind of from a bar graph standpoint, and this goes all the way back to 2010, same data. Instead of 5 years, we're going back to 2010. The average 2-day price reaction to an earnings miss, like the only time it's been better, this is this year, is here in 2020. Yeah, it's 2020, twice. So only 1, 2, 3, 4, 5, only 6 times, 6 different quarters, going all the way back to 2010, as the market has had a better or like response to earnings misses. That's pretty significant if you ask me. That's a significant data point. All right. Again, we've talked about, we've looked under the hood of the the hood of the car, the S&P 500, the NASDAQ. We've looked at breadth. One of the breadth measures that I was looking at earlier this week here was the NYSI, ticker symbol NYSI, which is the New York Stock Exchange McClellan Summation Index. If you want a broad measure of market breadth, go to the NYSI. It's a very broad measure of market breadth. I've got the S&P 500 in the lower panel here. These are 1-year charts. And as you can see, the NYSI, the Summation Index, bottomed in May and a really robust rally, a little bit of a check back, and it rallied basically back to this peak here in April. Now, while all that was happening from May going forward, right? So we've got this bullish action here. The S&P 500 still didn't bottom until mid-June. We got a bullish divergence there. And look at the pattern for a while here, right? Downward sloping pattern. Even though we've had these relief rallies here in 2022, relief rally in April, relief rally in late May going into the first week of June. But, this was still going down from April. Again, based here, suggesting that good things were happening underneath the surface of the S&P 500, even though it hadn't bottomed yet. And now look at where we are. We're almost back to unchanged on the summation index here, folks. As I say in this, which I tweeted out the other day, pay attention if we move into positive territory. It might be signaling that there has been that significant churn underneath the surface of the NYSE that is going to lead to more upside in the indices. This has been leading the S&P, the NASDAQ, the NYSE itself. They've been lagging. They made their lows in June. So we have a nice bullish divergence that might have predicted the rally that we've seen since basically the end of June through all of July. So keep this one, keep an eye on this one. I mean, still coming into today, we were actually at negative 11. We jumped up from the 26th. This was taken on the 26th. As of yesterday's close, we're at negative 11. If we can hold these gains here today, it wouldn't surprise me if we do move into positive territory. We shall see. All right, so looking at some of the performance ratios, right? We want to know, is growth going to outperform value? So we're looking at the Qs, NASDAQ, ETF, which is a growth index, and the S&P 500, a broad, value index, if you will. And as we noted in our weekly research report, we had this rounding bottom here. We also had this positive RSI divergence that started, here was the peak, and we're higher than that coming into this week. This was in our weekly research report to Finom group members, gets delivered every Sunday. So you can see on the 22nd, rounding pattern. Here's where we made the low in this performance ratio. Here's where we made the low and been trending higher. Through all of June, NASDAQ ETF has been outperforming the S&P 500 ETF, Spider. Recently got to what looks like nice way station here, right? A little bit of a check back. Let's see, do I have this up even? No, not yet. I want to look at that in real time after this check back. But we did have another thrust with yesterday's performance, I'm willing to bet. But this, basically peaked the RSI here, and we made it higher. We made it higher with a stronger RSI. In my opinion, this tells you that this is where you want to be. You probably want to be in growth stocks and or ETFs going forward. No guarantees, but the strength that we're seeing in this performance ratio suggests further outperformance of growth over value. I hear a lot about gap fills. People are always, oh, I'll wait till it fills the gap. I'll wait till it fills the gap. Bad idea, in my opinion. The problem with the majority of gaps get filled theory is that if you're beholden to that belief and use it as a means for allocating capital, market can catch a breath thrust that leaves above average, because we usually fill about 80% or so of gaps. They do. Most of them get filled. But if you use that for practical purposes, like you won't allocate until this gap gets filled and so on and so forth, if we do catch a breath thrust, you're going to have more gaps than usual go unfilled. And this is a perfect example. From 2020, we still have 1, 2, 3, 4 gaps open. Don't use gap fills as a means for capital allocation. There are far better metrics and stochastics to use other than gap zones. I just wouldn't be there. Fibonacci levels, so on and so forth. All right, so 1 year forward S&P 500 price returns subsequent to a 5 month. Some of you remember this. I kind of don't want people to forget, right? We talk about what's priced into the market. What have we pulled forward? Have we priced a recession? Have we priced in the full extent of earnings downgrade? We'll never know that in real time. But what we do know is, how the market has performed this year. And we can look back in history and say, okay, where were like circumstances? When did, in the past, the S&P 500 decline over a 5 month period 15% or greater? And based on that, we know historically what to look for possibly going forward over the next 12 months. Going back to 1957, a decline of 15% or greater for the S&P 500 has been followed by positive returns in the ensuing 12 months in all but 2 occasions. Only twice has the market had more declines since 1957 if the S&P 500 has fallen 15% or greater over a 5 month period. Now, don't forget that. It tells you that a lot is generally pulled forward. And the bottom is closer than you think. We might have bottomed in June, folks. Not saying we have. But things are starting to develop in a way that points to that as being the bottom. We'll see. We need more time. We need more of a trend to the upside before you can actually call that. All right, bear market recoveries. Generally takes 19 months to recover from a bear market or near bear market. Yet, going back to 1982, 1982, not all bear markets, just 1982, which was another midterm year, which was another decennial year. If the bear doesn't go down more than 30%, does not go down more than 30%, we've seen consistently quick recoveries, not 19 months, but 4 and 3 and 5 months. 1982 was just 3-month recovery. That's all it took to recover the losses. 4 months in 1990, which was a recession year. 3 months in 1998, 4 months in 2011, so on and so forth. Now, the one thing that all of these dates had in common, and maybe we'll get that this time as well, the Fed pivoted from tight to easy monetary policies. Every single one of these dates, no wonder, right? I mean, the Fed all of a sudden does, in fact, turn dovish, pause rate hikes, or maybe just instead of 75 basis points or 50 maybe they just do 25 basis points in September. I think the market will like that. I think you are going to see additional upside in that circumstance. Also the other difference here, so we can't say it's just going to take a pivot. The difference is we have QT. The Fed actually allowing assets to roll off its balance sheet and possibly even actively selling assets. So there's that dynamic that never happened in these occasions. In 2018, they were passively letting assets roll off the balance sheet, which is part of the reason why 2018 had a technical bear market. All right, something else I don't want folks to forget, right? Because we know 5 months, 15% decline. The reality is over 6 months, we had a 20% decline. By the end of June, we were down just a smidge over 20%. When you've had a 15% or greater decline in the S&P 500 over just a 3-month period, which we did because June was awful, and it was just carrying forward declines from May as well as April. The index has never closed lower 12 months later in the post-World War II era. The 3-month rate of change shows this may not be a bottom, but it is 100% of the time a buying opportunity. In my opinion, you better know the closing date. So if history repeats, the market should be higher than 37.85 come June 30th of 2023. Have to be higher than 37.85. 37.85 was the closing value on the S&P 500 on June 30th of this year. This has a 100% track record, folks. 100% track record. This should tell you also, anything below 37.85 this year during this bear market is just future opportunity. It's a means to profit in the future. That's why a couple of weeks ago in our weekly research report, I said, I almost hope that the bottom's not in, because I'd like to increase my equity market exposure. Study that we looked at on the NASDAQ, right? This is the NASDAQ above the 150-day moving average. We've cycled from having less than 5% of NASDAQ stocks above their 150-day moving average to recently getting upwards of 30% of NASDAQ stocks above their 150-day moving average. Historically, good things happen 1 year out. 100% of the time, the S&P 500 has been higher a year later and 2 years later. Again, opportunity. The maximum drawdown. Now, the lows weren't in these circumstances. Like, you actually still did have lower lows in the NASDAQ from the signal date. So once we've cycled from less than 5% to upwards of 25% of stocks trading above their 150-day moving average, the low for the index wasn't in, but good things were happening under the NASDAQ. But the low for the index wasn't in. The good news is that the lows or the additional drawdowns only about on average, let's say 5%, and the median about 5%. Worst case was in the dot-com bust period and post-recession. You had an 11% drawdown. Also, the good news is that most of these were within days, right? The signal fires here, but the actual low 4 days later. Signal fires here, a low about a month later. Signal fires 4 days later was the low. Signal fires 5 days later is the low. Signal fires 4 days later is the low, which you can see off to the side here. So the lows weren't too far off. Again, another indication that, yeah, maybe June was the low. Maybe. And don't forget, if June was the low, folks, you don't want to miss the next 12 months worth of returns. The average from a bear market trough is 43.7%. The worst going all the way back to 1948 was a 29% return. Good things usually happens when the market troughs. All right, let's talk a little bit of economic data. And again, I know that people are going to say this is a recession, back-to-back quarters of negative GDP. I'm sorry, folks. We've never had a recession when the savings, the household balance sheet, the accrued savings were this robust. We've never had a recession. It's not just that we've accumulated as households $2.5 trillion worth of savings. That's like 3 times any time period going all the way back to the 1980s. I've talked about the atom bomb to a recession. This is one of those atom bombs. You know, these are those gap fillers. We got U.S. durable goods orders this week. Surprise, huge jump. I mean, everybody was looking for a decline of about 0.8 because we had a really big jump in the prior month, but no. Durable goods orders came in at 1.9%. I mean, again, very robust, right? Last week, and in our weekly research report, we talked about the coincident index, the Philadelphia Coincident Index. Look, if the economy is going to be in a recession, we need states in recessions, right? The last time that we looked at the Philadelphia state-by-state coincident index, which basically tracks whether you're in contraction territory or expansion territory. You have, growing economic activity or shrinking economic activity. We had no states in contracting economic activity status. I'm sad to say we do have 2 now, Alaska, really, and Montana. Again, these are 2 of the least populous states in the union. Other than that, we still have no other states in contraction territory. How is this nation going to be in a recession when you only have 2 states in contractionary territory, and they just so happen to be the least populous states in the union? Retail sales. Like, okay, we had a bit of a reach. This was, kind of that spike. Might have had something to do with, I guess, the shopping season and whatnot, getting back from traveling, over 4th of July. But even trying to revert to the mean, we have a higher low. This is Johnson Red Book wheat retail sales, comes out every week. It's on a year-over-year basis. We're still in the 13s. I was actually expecting a bigger drop, maybe something, back down to here, because you have this boom. You kind of expect some kind of mean reversion bust, but only back to 13.3% year-over-year retail sales growth as tracked by Red Book Research, Johnson's Red Book. Here's Visa CEO this week. They beat on the top line. They beat on the bottom line. Visa CEO Al Kelly. Based on our numbers, we haven't seen any evidence of the consumer pulling back spending in our markets. Horse's mouth, right? Now, inflation, right? We're going to get the next CPI, I think, in 2 weeks. And it should be a good number, right? We're getting the July CPI where we saw rental prices cool off a little bit. We saw all commodities cool off big time. The year over year still shows growth, but the month over month, the headline number, should suggest that we've seen peak inflation back in the month of June. So the July should come out a lot better on the sequential or the month over month. Unfortunately, because we got to be honest with ourselves. We've got to look at the data objectively. And unfortunately, we had another uptick here in the Zumper, right? This is from Zumper. They track the as a national rental index, the rental market, one bedroom and two bedroom apartments, and they both had a slight uptick on a sequential basis. Same thing with Manheim used vehicle value index. That had a very slight uptick, as you can see here, in the mid-July period. We'll keep an eye on these, but these aren't suggesting the improvement that we want to see continue through July, through August, and through the end of the year, quite frankly. We'll keep an eye on those. Significant inflation peaks. Again, when inflation peaks and rolls over, the market tends to greet that with positive. And maybe that's what the market is also telling us, that June was peak inflation. That June was peak inflation because, 1 year forward results after each peak inflation. And this doesn't mean that we had a spike in inflation for each one of these years. It just means that we did have a significant top and a significant decline from there. Going all the way back to 1951, the average return 1 year later, 13%. Wall Street, this is the estimates right now for the year-end price targets. Got a lot of high numbers here. This is where I am. I think we can achieve 4,300. I don't know if that's exactly where we're going to end the year at, but I think we can achieve it between now and year end. We'll see if that comes to fruition. All right. Thank you for joining us again this week on State of the Market. Tune in next week and visit us at finomgroup.com to get this every Thursday. We only publish it on YouTube freely the following week. So if you want it in real time every Thursday, subscribe at finomgroup.com.